Part 1. Opening Scene. A credit card machine approves a transaction. A college student buys coffee in New York City.
One coffee, please.
A truck driver fuels up in
Thanks.
Texas. A tech founder raises billions in Silicon Valley. Different people, different lives. One common thread. They are all using money they don't currently have. That is the secret. America does not run on cash. America runs on credit. And tonight, we are not asking, is credit good or bad? We are asking something much bigger. How did an entire civilization build itself on borrowed trust? And what happens if that trust cracks? Part 2. What is credit? Imagine your friend says, "Give me $100 today. I'll return $110 next week." You are not giving money. You are giving trust. That is credit. Credit equals trust plus time plus promise. Three simple elements. Trust. I believe you will repay. Time. Payment happens later. Promise. A legal obligation to return. Now scale this up. When a bank lends you $10,000, they don't give physical cash. They create a number in your account. That number exists because they trust you will repay. This system is called Fractional Reserve Banking. Let's simplify that. If a bank has $100 in deposits, it does not keep all $100 locked away. It may keep only a small fraction, say $10. The rest it lends out. So from $100, it can create $900 in loans across the system. Money expands. Not from gold, not from printing, but from trust. Part 3. The origin story. How America became a credit nation. In the early 1800s, America had land but little cash. No gold mountains like empires. No ancient wealth. So how did it grow? Through debt. The U.S. government itself borrowed heavily. After the Revolutionary War, leaders like Alexander Hamilton argued, if we manage debt wisely, it becomes a national asset. Strange idea. Debt as strength? Yes, because if investors trust the U.S. government to repay, they buy its bonds. That trust becomes power. Over time, this trust solidified through institutions like Federal Reserve, U.S. Department of the Treasury, Wall Street. America built something new, a financial empire. Not based on conquering land, but based on issuing promises the world believed. Part 4. The Machine. How credit creates the modern economy. Picture the economy as a giant engine. Fuel equals credit. Without credit, businesses can't expand. Families can't buy homes. Students can't attend college. Startups can't innovate. Let's walk through the pillars. Consumer credit, the American lifestyle. Credit cards, car loans, mortgages. Americans don't wait 30 years to save for a house. They buy now, pay later. That pay later system drives 70% of U.S. GDP, which comes from consumer spending. If people stopped borrowing, the economy would slow instantly. Credit keeps demand alive. Corporate credit. Companies run on debt. Companies like Apple Incorporated and Amazon issue bonds, even when they have cash. Why? Because borrowing at 3% to invest in something earning 10% is smart leverage. Leverage equals using borrowed money to multiply returns. Without credit markets, modern corporations shrink. Government credit. The world's biggest borrower. Deep structure. Let's zoom in. The U.S. government does not print money to fund itself in normal times. It borrows first. From whom? From anyone willing to lend to it in exchange for a legal promise. That promise is called a U.S. Treasury security. Issued by the U.S. Department of the Treasury, backstopped by the credibility of the United States government, supported by the monetary system managed by the Federal Reserve. Now let's slow this down. Step 1. Why does the government borrow? Because spending exceeds tax revenue. If the government collects $4 trillion in taxes but spends $5 trillion, there is a $1 trillion gap. That gap is called a deficit. To fill that gap, Treasury issues bonds. Simple, but the implications? Massive. Step 2. What is a Treasury bond, really? A Treasury bond is a legally binding IOU from the U.S. government. If you buy one, you give the government $1,000 today. It promises to pay you interest every year and return your $1,000 after a fixed time, 10 years, 30 years, etc. There are 3 main types: Treasury bills, short-term under 1 year; Treasury notes, 2 to 10 years; Treasury bonds, 20 to 30 years. Together, they form the backbone of global finance. Why? Because they are considered the risk-free asset. Not zero risk in theory, but the closest thing to guaranteed repayment in the world's financial system. Step 3. Who buys this debt and why? 1. American banks. Banks are required to hold safe assets. Treasuries are perfect, liquid, stable, accepted everywhere. They can also use them as collateral to borrow from the Fed. Treasuries are not just investments, they are plumbing for the banking system. 2. Pension funds and insurance companies. They need predictable income. If a pension must pay retirees for 30 years, it needs long-term stable returns. Treasuries provide that. They match future liabilities with government-backed income streams. 3. Foreign governments. Here's where geopolitics enters. Countries like China, Japan, and oil-exporting nations hold massive amounts of U.S. debt. Why? Because they trade with America. They receive dollars. They need a safe place to store those dollars. What's the safest dollar asset? U.S. Treasuries. So global trade surpluses recycle into U.S. debt. This is called the dollar recycling system. America imports goods. Other countries accumulate dollars. They lend those dollars back to America by buying treasuries. It's a loop, a very powerful loop. Step 4. Why this makes the dollar the global reserve currency. Now we connect the dots. A reserve currency is the currency other countries hold to settle international trade. The US dollar became dominant after World War II through the Bretton Woods system, but it stayed dominant because the US economy was large, its financial markets were deep, its government bonds were reliable, its legal system was stable. You can hold dollars in cash, but that's inefficient. Instead, central banks hold US treasuries. That creates constant global demand for US government debt, which means America can borrow at lower interest rates than most countries. That is financial superpower status. The hidden mechanism, why trust is self-reinforcing. The more people trust treasuries, the more they buy them. The more they buy, the lower interest rates stay. Lower rates make debt manageable. Manageable debt reinforces trust. Trust lowers rates again. This is a positive feedback loop until confidence breaks. Then it becomes a negative loop. Financial markets, the amplifier. Now we move to the multiplier. Government borrowing is the foundation. Financial markets are the accelerator. Enter Wall Street. But don't imagine buildings. Imagine a system of interconnected contracts. What does Wall Street multiplies money mean? It means this. Credit is not static. It can be traded, packaged, sliced, resold. Let's use an example. Example, a simple mortgage. You borrow $300,000 to buy a house. A bank gives you the loan. Traditionally, the bank would hold that loan for 30 years. But modern finance does something different. The bank bundles your mortgage with thousands of others. This bundle becomes a mortgage-backed security, MBS. Investors buy shares in that bundle. Now your monthly payment flows to investors around the world. Your house payment becomes a tradable asset. That's the amplifier effect. Why do this? 2 reasons. 1. It frees up bank capital. If the bank sells the mortgage, it gets cash back. It can lend again. More lending equals more credit creation. 2. It spreads risk. Instead of one bank holding all risk, thousands of investors share it. In theory, this stabilizes the system. In practice, if risk is mispriced, it spreads crisis globally, which is exactly what happened in 2008. The master mechanism. Government plus markets together. Here's the master mechanism. 1. The government issues treasuries. 2. Treasuries become the safest asset. 3. Financial markets use treasuries as collateral. 4. Banks build credit on top of that collateral. 5. Investors trade layers of risk above it. Treasuries are the bedrock. Everything else is built on top. Like a skyscraper, foundation equals government debt. Steel frame equals banking system. Glass exterior equals financial markets. Offices equals consumers and corporations. If foundation cracks, everything trembles. Why this system is so powerful? Because it connects government policy, central banking, global trade, private investment, consumer behavior into one integrated machine. No other country has financial markets this deep. No other country issues debt at this scale with this level of global demand. That is why America runs on credit, not recklessly, but structurally. The real tension. The system works because the world believes the U.S. government will always honor its debt, and because the Federal Reserve can provide liquidity in crisis. But here's the dramatic truth. The entire global system is built on confidence in one sovereign issuer. That's extraordinary and fragile, because credit is not physical, it is psychological, and psychology can change faster than mathematics. Why America chooses credit. 3 strategic advantages. 1. Speed of growth. Credit compresses time. Instead of saving 20 years to build a factory, a company builds now and repays over time. This accelerates GDP growth. America became the world's largest economy partly because it mastered financial acceleration. 2. Risk distribution. Debt spreads risk across investors. If one project fails, losses are distributed. This encourages innovation. Silicon Valley exists because investors fund risky ideas with borrowed capital. Most startups fail, but the few that succeed transform the economy. 3. Global power. When the world uses your currency, you gain geopolitical leverage. If global trade depends on dollars, dollar demand never disappears. This allows the U.S. to borrow at lower rates than most countries. Credit becomes foreign policy. The psychology. America's culture supports credit. The American dream encourages home ownership, entrepreneurship, higher education, all expensive. Credit makes dreams immediate. Culturally, debt is normalized. In some countries, debt is shameful. In America, it's standard. Your credit score becomes your financial identity. It measures trustworthiness. A number between 300 and 850 decides your loan rate, your mortgage approval, even rental applications. Trust becomes quantified. The trust loop. Credit only works if trust remains. If lenders doubt repayment, interest rates rise, borrowing slows, spending drops, growth declines. This is called a credit contraction. If severe, it becomes recession. So the system must constantly maintain confidence. This is why central banks communicate carefully, why markets watch every speech, why stability narratives matter. Because perception affects trust, and trust powers the machine. Is America addicted to credit? Now the uncomfortable question. Is this sustainable? America's national debt exceeds GDP. Consumers carry trillions in credit card and student debt. Corporations leverage balance sheets. Is this strength or dependence? It depends on growth. If GDP grows faster than debt, the system stabilizes. If debt grows faster than productivity, strain increases. This is the balancing act, like walking a tightrope. As long as trust holds, the rope stays steady. If confidence drops, volatility increases. What if credit disappeared? Let's imagine, tomorrow, no loans, no credit cards, no bonds, no mortgages. Immediate effects. Housing collapses. Businesses stop expanding. Government spending freezes. Consumption shrinks. GDP would contract sharply. Unemployment rises. Innovation slows. Credit is not decoration. It is structural. Remove it, the skyscraper trembles. The future. 3 forces challenge the system: rising interest rates, political polarization, alternative currencies, and digital finance. But so far, no country has matched the depth of U.S. financial markets. The dollar remains dominant because trust remains relatively high. Until a better trust system emerges, the credit engine continues. The real meaning. Return to the opening sound. Beep, transaction approved. But now you understand. That beep is not money moving. It is trust moving. From bank to borrower. From present to future. America runs on credit because it believes tomorrow will be bigger than today. Credit is a bet on the future. And for over 200 years, that bet has largely paid off. But remember this. Credit magnifies. It magnifies growth, and it magnifies mistakes. The same system that builds empires can trigger collapses. So the real question is not, why does America run on credit? The real question is, how long can trust be sustained at this scale? Because in the end, America does not run on dollars. It runs on belief. And belief is the most powerful currency ever created.